Today's episode is about something every investor, every operator, and every capital allocator should understand deeply, but very few actually study properly. How small acquisitions, tiny, almost invisible deals, compound into giant multi-decade shareholder returns. And I'm not talking about private equity roll-ups, I'm not talking about venture-backed consolidation plays. I'm talking about one of the most misunderstood and one of the most powerful business models in the public markets. I know most of you listening are private market investors, but what I'm about to share today, all those small companies, which today are huge ones, again, they started as a small private companies, and in one moment they just did an IPO and went public. We're going to talk about acquisition-driven compounders. And these are the companies that quietly buy dozens, sometimes even hundreds, of niche, profitable companies and let them compound for decades. And the results, simply staggering. Take Lifco, 21x since IPO, which is like 33% CAGR. Take Addtech, 210 times since 2001. That's 26% CAGR. Lagercrantz, 120x since 2001, since doing an IPO, 23% CAGR. Constellation Software, 375x since 2006, it's 37% CAGR. And Heico, 1100x since 1990, which is 22% CAGR. Think about these numbers. A $10,000 investment in Constellation in 2006 is now nearly 3.7 million. A $10,000 investment in Addtech in 2001 is now 2.1 million. And here's the crazy part. They didn't do it by innovating anything. They didn't do it by raising huge rounds. They didn't do it by swinging for the fences. They just bought small, boring, profitable private businesses. They did it again and again at 5 to 8x EBIT with founders who stayed inside a decentralized culture, and they let time, cash flow, and discipline do the compounding. So today we are walk you through why tiny acquisitions outperform big deals, how decentralization creates anti-fragility, why tiny markets are better than big markets, and how Nordic compounders become world-class capital allocators. Because the many companies I mentioned to you, Lifco, Addtech, Lagercrantz, these are all Sweden-based companies. Constellation Software is Canadian, and Heico is US. You're gonna learn as a private buyer, GP, LP, or a simple HoldCo builder, how you can apply those same lessons immediately while building your own portfolio, just buying maybe a few companies. Because this episode is built around one of the best pieces of research I've seen in a long time, and it's very data driven, it's dense, and I'm gonna give you so many insights that translate perfectly to what we can do as a private market investors while buying those small niche businesses. So my job today is translate that into HoldCo builders language, which is hopefully very practical, a lot of stories, at the same time being operator focused. So let's get into it. Engine number one is organic growth in the unsexy corners of the economy. And when compounders talk about organic growth, they are not talking about blitz scaling or product sprints. It's organic growth inside a Lifco or Addtech, and this is how it looks like. Number one, incremental product improvements. A company making specialty O-rings creates a new polymer blend that lasts 25% longer. A niche industrial sensor manufacturer adds a cloud-based dashboard. Precision pump company redesigns a valve to reduce leaking by 2%. You can see very tiny changes. On paper, obviously, super boring, but in reality, massive ROIC, higher pricing, and zero churn. These small improvements create loyalty and decades-long switching costs. Another thing, extreme customer intimacy. Imagine a supplier of a control system components who literally sits inside a paper mill for a week to understand failure points, or a manufacturer of dental surgical tools who personally trains 500 dentists a year. The closeness to the customer simply doesn't happen in the large corporations, it's in the niches, and intimacy is the moat. So next time you're building a company or you're making an investment, you have to think about how you can do the similar type of things, because not too many large corporations are willing to do that. Another thing is that small markets no one else wants. I'm giving you some of the examples. Heat-resistant gaskets for nuclear reactors, high-pressure hoses for Arctic fishing vessels, symmetry plot management software, custom conveyor belts for sawmills, fume extraction system for dental labs. These niches are too small for strategics, and they're very boring for PE because many of them, they just don't understand how it works. But again, it's perfect for those compounders. Faster opportunity capture because everything is decentralized. A CEO can adjust pricing, they can hire talent. A CEO can also launch small product variations, and they can buy a new machine, all without waiting for HQ approval. I'm giving you an example. A Lifco subsidiary making demolition robot components changed pricing weekly during supply chain madness. A centralized company could never move that quickly. This is the quiet power of organic growth in the niche markets. Next thing you need to understand, let's call it like engine number 2, programmatic M&A. The compounding engine that makes everything explode upward. And here's what the target companies actually look like. Take like industrial niche manufacturers, products like robotic grippers, micro motors for surgical tools, industrial fit and forget components, specialized water treatment valves, flow meters for dairy processing, and a lot of new niches, I'm sure, like industries you haven't heard before. And there are companies doing 3 to 25 million in revenue. They operate at 15 to 30% EBIT margins. They're super sticky to customers, long product life cycles. They're boring, profitable, and essential. They sell low volume, high value products that customers can't easily replace. Or they specialized B2B distributors. Examples: fiber optic installation components, industrial cooling systems, railway fasteners, lab testing consumables, underwater welding gear. And again, with those companies, they win through expertise, not by scale. The famous ones: vertical market software, funeral home management software, parking management systems, ice rink scheduling software. Think about this: ice rink scheduling software. How many ice rinks do you know? I know 2 because my kid is going every single week, twice we go and skate on those ice rinks. But there is a niche: ice rink scheduling software. That's insane. Next one: marina ERP systems, school cafeteria accounting platforms. Obviously, there are thousands of schools, tens of thousands of schools, and they each have a cafeteria. And there is school cafeteria accounting platforms. This is wild. That's why I wanted to create this episode, because I was doing this research, and this will hopefully open your eyes when you walk on the street, when you go inside those buildings, or just drive around your hometown. Just look left, look at right, see those different businesses, and it will open your eyes. There are so many different niches. Look at different products, services. It's just insane. Look at the things you're using every single day. Look at what your kids are using every single day. There are products for everything. Again, ice rink scheduling software. School cafeteria accounting platforms. Again, this is crazy. Because these companies typically have 90 to 95% recurring revenue. They have nearly zero churn. They have 20-year customer lives. And these things are recession-proof. Let's go even more niche. Healthcare and dental tools. Orthodontic brackets. Endodontic tools. Surgical lighting. Lab milling instruments. Again, all those things, super high margins, high frequency, mission critical products. I know many words in here. Personally, I had to Google like what do they mean, how does those tools look like. And maybe because of my pronunciation, you might not maybe understand all this, but again, feel free to send me a message. I'm happy to share my notes because there's so many interesting niches you don't even know existed again. Another thing, demolition and specialty equipment, remote controlled demolition robots, hydraulic crushers, industrial saw blades. One demolition robot subsidiary grew 30x in 30 years. It owns 70% global market share and has 30% margins. This is the data. You can see like such a small niche, but in this niche, you can just have those wild returns. I mean, like 30x in 30 years by owning 70% of global market share and again having 30% margins. Another thing, system solutions, the everything else box. Giving you some examples. Climate sensors for mushroom farms, airport runway lighting controls, marine navigation electronics, industrial fire suppression systems. Again, if it's niche, durable, and high margin, those serial acquirers, they want those businesses. And these companies share the same DNA. Across industries, compounders, they all target the same things. Founder ownership, 40 to 80% gross margins, 15 to 30% EBIT margins, mission critical products, decades long customer relationships. They're boring, stable cash flows, small markets with no competition. These businesses are niche gems, and private equity very often ignores them. And strategics, they overlook them. But compounders, they collect them. That's why they keep growing on year-to-year basis. I'm giving you some examples. Addtech, the Swedish serial acquirer, they bought a company making heat-resistant electronical connectors for trains. Imagine the niche. And they were able to do 25% margins, and they had zero churn. Lagercrantz, they bought a humidity sensor maker used in museum archives. Only 2 to 3 global competitors. Lifco bought a dental lab tool maker whose top product hasn't changed in 15 years. Vitec Software owns ERP systems for real estate agencies, fire departments, and churches. The Constellation Software bought Estonian software that manages the entire national library system. I know this to be true because I visited different libraries and it's all the same. They use the same exact software. And the Estonian market is just 1.3 million people, and Constellation just owns a very small niche in this very small market. This is super boring on the outside, but it looks very beautiful on the balance sheet, and that's why I wanted to do this episode, to just open your eyes. Next time you use something, think about the niche, and there's probably few companies only which provide this type of service or product. Now, if you're listening and you're really like thinking, okay, I love these types of businesses, but I don't necessarily want to be on hunting or operating all of them, then this next part is special for you. And I want to talk about today's sponsor, CapitalPad, because if you're interested in deal-by-deal private equity investing, CapitalPad is a platform where accredited investors can back lower middle market acquisitions alongside experienced independent sponsors. Investors on CapitalPad have already participated in 8 successful deals, and new opportunities only go live when they pass CapitalPad's own quality bar. So we are not shifting through a marketplace of random listings. Think of it as a curated bridge between capital and great small companies. The kind of niche, profitable, boring businesses we've been talking about in this episode today. And CapitalPad connects accredited investors with independent sponsors who are out there sourcing and operating deals in the 5 to 50 million enterprise value range. If that's the part of the world you want exposure to, but you don't want to run a small search fund yourself, it's worth a look. You can learn more and see if it's a fit for you. Go to capitalpad.com. I'll also drop the link in the show notes. So we've talked about the types of companies these compounders buy. Now let's zoom out and look at what happens when you own hundreds of them. How that creates resilience that most PE funds can only dream of. Again, Lifco has 200 subsidiaries. Indutrade has 200. Constellation over 800. Traditional conglomerates diversify top-down, but compounders diversify bottom-up. If a PE firm has one bad deal returns might collapse, but if Lifco has a bad deal, nobody notices. Take again, Lifco, 21x growth since IPO. They do 15 to 25 acquisitions per year, ultra low leverage, 10 to 15% ROC, and decentralized ops. As their CEO said, the important thing is we can take care of the companies we buy. Again, not integrate, not centralize, but take care of. This is the big part. So how big can they get? The answer, bigger than anyone thinks. AddLife's former CEO described the 777 model, 7 HQ staff, 7 business areas, and 7 companies per area, which means 343 manageable subsidiaries. Constellation Software CEO revealed their average business unit has 44 employees. Size and performance, almost unrelated. They intentionally avoid scale because scale creates bureaucracy. Now we arrive at the most important part. What you, private buyer, HoldCo builder, can apply immediately. Everything up until now has been how compounders work, how they grow, how they structure themselves, what types of companies they buy. Now let's talk about you and what you can take from these giants and use today. Here are 7 principles that apply whether you own one HVAC business, 2 dental practices, 3 e-commerce brands, or a multi-company HoldCo, or you're just in very early stages of actually buying a business. I believe these principles scale down just as well as they scale up. So let's begin. You have to do small, repeatable deals, not big swings. Compounders avoid big platform bets. They avoid large, risky deals, and they avoid complexity. They buy 3 million industrial gasket companies, 5 million surgical tools manufacturers, 7 million demolition equipment suppliers, 4 million B2B distributors, 6 million vertical market software companies. Obviously, to buy a 6 million vertical market software companies right away, it's too much, but hopefully today you've seen so many different niches that there are some smaller players, some even do less than $1 million in sales. But as we've discussed many times, then the margins, even the net margins, they're super high because there's not too much competition and those customers very sticky. So again, putting it all together, they're individually very tiny, but collectively these are massive portfolios. And if you take the founder of Constellation Software, Mark Leonard, he has said, why not own a bunch of great small businesses? It's a great way to put it. Why not own a bunch of great small businesses? And the HoldCo takeaway from this is, if you buy 1 to 3 small profitable companies per year for the next 5 or 10 years, you will outperform 95% of private equity funds. Another thing, you have to keep founders because culture compounds faster than capital. Founders are the business. They know every customer, every supplier, every weird product quirk, every pricing nuance, every employee strength, every tribal knowledge detail. And those compounders we've been talking about today, they want founders to stay. They roll equity. They encourage autonomy. And again, the HoldCo builders takeaway. Your number one risk is a founder who wants to disappear tomorrow. And your number one accelerant is a founder who stays for another 3 to 5 years. Another thing, decentralized operations, where you have to let operators operate. Don't integrate. Don't centralize. Don't roll up. Lifco has 15 people at HQ. Constellation has small teams per unit. Remember, I said 44 employees on average. What is the takeaway? Your company should feel independent. Your CEOs should feel like owners. And your HQ should be tiny. Another thing, centralized capital allocation. The one thing HQ must own. Decentralized ops, centralized capital. HQ should only do capital budgeting, ROIC discipline, incentive systems, and M&A evolution. Everything else, push it down. The takeaway here is your job isn't to run companies. Your job is to decide where each marginal dollar goes. Quick break for something that a lot of you, especially the LPs, GPs, fund managers, business buyers, you will find it interesting. This episode is also sponsored by Spacebar Studios. They are the newsletter team behind some of the fastest growing B2B publications out there, and they've been supporting this show for some time already. This December, they are doing something totally new. You can hire them for $0 upfront. They will build out your newsletter strategy, they will build out your systems and content foundations for the month December. And you don't pay $1 until January. So if you're running a fund, a holding company, or you're just serious about building a real audience of operators and investors and clients for your own business, a good newsletter is one of the highest ROI assets you can own. It compounds trust in the same way these businesses compound capital. And Spacebar is only opening this to 2 companies. And when those slots are gone, they're gone. So, because they have a small team to manage it all. If you want 2026 to start with a momentum instead of endless planning meetings, go talk to Spacebar Studios. You can grab a slot directly on the Calendly. I'll put the booking link in the show notes. And now let's get back to operating playbook and talk about one of the biggest mistakes roll-up make: chasing synergies and killing culture. Roll-ups die from forced integration. Again, do not chase synergies. You have to protect the culture instead. As I said, roll-ups die from forced integration. They die because centralized purchasing, shared systems, mixing sales teams, merging organization charts. There is a Swedish serial acquirer named Bergman Beaving, and they tried to do this back in 2006, and it nearly killed them. They spent a decade unwinding it. And the takeaway from this: if you think you see synergies, remind yourself, culture loss costs more than synergy gains. So you want to acquire companies in dominant niches, the biggest arbitrage in SMB buying. Forget big markets, forget damn slides. The compounder model loves tiny markets. 15 million market for humidity sensors in museum archives, 30 million market for airport lighting controllers, 50 million market for mushroom farm climate sensors, 20 million market for library management software. Small equals defensible, small equals price power, and small equals no competition. Because if you find a niche where you can be number 1 or number 2, that's worth more than being number 10 in a massive market. I know many will say that, are you sure? But when you look at those compounders and the type of companies they are acquiring, there's just so much less competition on those deals when you're going and trying to acquire a player number 10 in a massive market. Because I think one thing you've learned today is that there's so many niches and so many companies you didn't even know exist. The best compounders promote from within. Lifco trains subsidiary CEOs. Addtech has internal leadership academies. Constellation elevates portfolio managers. This creates a flywheel of internal talent, because your future group CEO is probably already in your current companies. And now I believe the most exciting part: you are playing the same game. Because if you own 1 company, 2 companies, 5 companies, more than 10 companies, or you're just about to acquire your first, you are at the beginning of the same journey Lifco began 30 years ago, the same journey Addtech began in 1980s, and the same journey Constellation began in 1995. The business you buy today will throw off cash that buys the business tomorrow, that throws off the cash that buys the business after that. This is the quiet flywheel of acquisition-driven compounding. This is what every LP and GP should understand. This is how wealth is built over the next 20 to 30 years and not 2 to 3 years. And the best time to start that journey is today. So thank you very much for listening. I really hope you learned a lot, because I did. If you want the notes, just send me a message. If you're first time in here, make sure you subscribe if you haven't already. And if you learned something new or some interesting niches, make sure you share this episode with your friend. It would mean a lot. So again, thanks a lot for listening, and see you in the next one. Bye-bye.